Hello, everybody. Welcome to the technical analysis webinar here with AvaTrade. My name is Troy. I'm a senior account manager with the company. I'll be presenting today. I apologize in advance due to the unique time that we're doing the webinar today. Some COVID-19 restrictions actually going on with myself and my family. So it's going to be a little bit noisier, maybe in the background than usual. I apologize in advance. But we'll get through it, and I think everyone will be able to follow what we're doing and hear okay. Give me a quick okay in the chat box if you're hearing me clearly and seeing the screen all right. All right, great. Thank you all. I've got enough responses. Looks like we're up and running fine. And also apologies, last Tuesday, which was also a unique time and day for the webinar, I had to cancel last minute, again, for the same reason. So, but we're getting through, and you'll notice this week, Friday's webinar is on Thursday. That's also for the same reasoning. And then the next week also, the times are shifted just a little bit. And then after that, we should be back to our normal Monday evening and Friday afternoon schedule with the webinars. But keep in mind, all the webinars are recorded. So if you can't catch them live, by the next business day, they're uploaded. And a lot of times the entry points can still be relevant. And even if they aren't on the specific assets we were looking at, the strategies certainly still are relevant to be used in the future. Okay, so with that said, let's move forward. Keep in mind, as always, no one trade is guaranteed to bring profit. There's always a risk of some type of loss, depending how you're managing your risk with any trade that you're taking. And this is true with all investments, and obviously is true with CFD trading, spread betting, options trading, etc. And so you can read our full risk disclosure statement on the AvaTrade website if you so choose. Also, keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective to hopefully add more tools to your tool belt, so to speak, so that you can improve upon or build trading strategies that hopefully in the end are more profitable by gaining more information and having different ideas for managing things. Now, one thing we'll cover that is useful as long as we're talking about risk is on the AvaTrade Go mobile app. If you haven't downloaded it to your mobile devices, I recommend you do. We continue to add upgrades to the functionality of it to have more and more features available. Currently, you'll find that in the order window, it acts as a trade calculator to calculate your exposure to your stop loss mark, your potential profit to your take profit market, automatically converts it to your account currency when showing you those numbers. It also calculates your margin requirement for you as you're setting up the trade as well. And also has a feature called Ava Protect, which allows you to protect against losses for defined time periods for a small premium cost. So those are all things you'll find on the AvaGo app that actually help with your risk management strategy and functionality. Now, as we get into the technical analysis, there are two main ways that you might do technical analysis. One is manually, which we do a lot in the webinars, meaning finding your own price levels, your own trends, drawing your own lines for support and resistance, etc. And the other way is to use indicators, which we also use on occasion, whether that's a relative strength index or using something like Fibonacci levels, which is a preference of mine. Indicators can also maybe not act as the #1 guide, in my opinion, for finding entry points and exit points in trades, but indicators can act as a supportive mechanism to reassure you of your own price levels and what you're already thinking to maybe give you a better idea of when to enter and exit trades as well. So as part of a strategy, indicators really can be useful. But I tend to lean on the manual methods first anyways, because I think I trust myself more than I trust a pre-programmed indicator, which can be helpful, but certainly has some limitations. Now, as we go along, if you have any questions, you want to give input, please do so. And let's go ahead and get going. First, we'll take a look at some of the fundamental news that's out there. And And if you're wondering where to find the AvaGo app, it's here, trading platforms, AvaTrade Go, right on our main website. It's in your app store. You'll find it by keyword search as well, or just follow the link from here. And you can see how it works, how the order window calculates margin requirement. If you put the stop loss or take profit, it calculates your exposures and such. AvaProtect, if it's available, you'll see it in the order window. Not all assets have it. Gold, silver, and FX have it. For a certain length of time coverage, it requires a certain premium cost, but then any losses are covered for that entire time period. Any floating negative when the coverage period ends gets added to your account. The trade can keep running. So very nice features on that app. You could check it out. Now, to look at what's happening in the news front, on the fundamental side, just quickly before we get on the live charts for our technical analysis. Katerina, hello. Glad you made it. Okay, so this is the general idea. US dollar has been weakening today. Why? And you can see the dollar index down over 0.5%. That's a pretty significant weakening of the USD against a mix of currencies. So the dollar index gives you an idea that this isn't just a pairing where maybe the USD is weakening against just the euro or just the pound. It's actually weakening against a basket of currencies against it. Euro USD, GBP USD, USD JPY, USD Swiss franc, etc. are all in the dollar index, okay? And the USD is weakening significantly. The question is why, and it stems on some doubts about the US economy's recovery, okay? So that's one thing to keep in mind, that although the US indices are green, the futures are green, meaning there's optimism still on the stock market and it's still going up. There's kind of an imbalance occurring today. Usually when you see the US dollar weakening, you see the volatility index is up, meaning fear is up. The VIX 500 is referred to as the fear index, the volatility index. It's rising. Usually when fear is rising, you see the futures dropping, and they're not, they're climbing. So I think this is a setup today for a large move. Good question. Someone's asking what color means fear is up with the VIX index? Green. When it's green, it means it's climbing. It means it's in the positive for the day. And when it comes to volatility, green means increasing fear, okay? Rising fear means usually the futures are red usually when we see that, and they're not, they're green. So the question is, which one is going to break? Is the volatility going to all of a sudden come down and the futures will keep rising? The indices will keep rising, the stocks will keep rising, or are the futures, the indices, and the stocks due for a pullback to correct for the fact that fear is going up? It just ticked above 2% now while we're watching the volatility index. So this is setting up where maybe these indices are due for a large move because fear is up and they haven't responded yet. They kept climbing. Yes, this class is for beginners and advanced, and you can ask any basic questions you want or advanced questions, and we'll make sure everyone understands. So the general idea then, as we look at the markets, it's mixed. We see mixed on the fundamentals. We see the futures are green, the indices are rising, but fear is up. So it's kind of a mixed bag right now. Now we look at more headlines, okay? Not a lot of announcements today so far. We do see that there's some high-level announcements coming at 8:30 New York time, 8:30 a.m. New York time. So later in the afternoon, London time, there'll be some announcements out of the US that could move the indices and the stocks and gold for that matter and oil. So then we see what else is happening. China seizes US consulate in Chengdu, retaliating for the US seizing the Chinese consulate in Houston. So this can add to the fear. That's something maybe causing the fear to be up. That's not good news. If the two largest economies in the world, the US being the number one largest economy and China being number two, size-wise, boy, that's bad news if there's some problems brewing between US and China, which it looks like there are some problems brewing. U.S. closed the Chinese consulate in the U.S. in Houston, accusing them of spying. Not saying maybe, but flat out saying you are spying and we're closing your consulate. They raided it the other day. They used a locksmith to break the door open. And the Chinese were burning documents and destroying evidence of whatever they might have had in there. So, and now the China has retaliated, seizing control of the U.S. consulate. So not so good right now for, what's that do to the hopes for a trade negotiation like was happening before the pandemic? The U.S. and China had these trade negotiations going on. Boy, that doesn't look good now. So another reason for fear to go up and maybe markets to pull back, fundamentally speaking. This is leading to fear. The Feds have a meeting this week. The folks in the U.S. that determine monetary policy have a big meeting this week, okay? And so there's worry about the fact that bond prices are going up while the stock market's going up. And that usually doesn't happen. Usually when bond prices are going up, it's because there's high demand for bonds, which are considered a safe haven like gold. So gold shot up to a record high today, right? 1940 or something like that. Gold went through the roof. That's a safe haven climbing. People are leaving the USD right now. Gold is climbing. US bonds prices are going up, meaning there's high demand for safe haven bonds. So the question is, why is the stock market still climbing? Okay, maybe it's because expected stimulus to pass in the US, another $1 or $2 trillion of stimulus. So that's helping the stock market artificially stay up. Okay, so but what is this setting up for? If the FOMC comes out and says, hey, we have to change policy, the bond prices are out of whack with the stock market climbing, out of balance with bond prices. So there's a lot of fear brewing about that as well, with what the FOMC committee in the US might say. Okay, so all of this is setting up for huge potential movements on stocks, and we have hundreds of stocks available now on the MT5 platform. Like a couple hundred more were added compared to what's on the MT4, which was already a good selection. So if you haven't added the MT5 to your user account, you can easily do that to your existing user accounts and trade on any of the hundreds of stocks that we have available. So if you expect maybe a large movement in some of these assets, boy, it's setting up for, with these potential fear problems occurring between US and China, talks with the FOMC committee later this week about bond prices being out of whack with the stock market prices, and gold soaring to record high. Okay, stocks stay uncertain. Another headline, right? What is the sentiment right now? Is the sentiment positive or negative for stocks and the indices? It looks like it's more negative than positive. Gold is going through the roof to record high. Bond prices are going through the roof. It looks like there's a setup here for maybe a major pullback on stocks and indices. No guarantee, right? We went into this saying there's no guarantee. But wow, what potential, right? We're talking about potential here. So let's get on the charts and let's see what's happening. I'll pull up my demo account. These are the live movements, same as your live accounts. And why not start out with gold? Okay, here's the resistance level on the 1 month candles on gold, and we broke it today. It broke the 1 month candle resistance on gold today. So that goes back over a decade. We're talking, this is, or almost a decade. I take that back. We're talking 2010, 2011. It just broke like a decade-long high since 2010, 2011. Okay, 9-10-year high. It broke it today. That's a significant move. That's telling you something, that a safe haven like gold just broke through that resistance and hit 1914. And the resistance was at 1914, and now it's hit 1940. Okay, so quite a breakthrough. So let's go to the 1 hour candles. Look at this movement. It broke into 1900 just today when the market opened, and now it's quickly climbed to 1940. That shows you something. Now, whether you want to trade on gold now or not, that's up to you. You could have had a pending buy stop on gold, 1 month candles. Here's the 1 month resistance. If you had put a buy stop just above that resistance, you're talking, if we then go back to 1 hour candles, there's that breakthrough level above the 1 month candle resistance. This was the 1 month candle resistance, the breakthrough, you could have triggered a buy stop here, pending order, and been up $20 per ounce. Very simple technical strategy, okay? Find a resistance level that hasn't been broken for a long time. Put a pending order that triggers if it breaks it. In this case, it would have triggered if it broke 1914, was the 1 month candle resistance that hadn't been broken for over 9 years. It broke it this morning. A buy stop pending order above that resistance would have paid quite well in a short period of time. The longer the resistance level has been unbroken, or support level, in this case resistance level, the bigger the breakthrough move tends to be if it breaks. We did the same thing with oil, okay? So we see this big move, $30, $40 move in oil, or I mean in gold and per ounce, and you easily could have had a pending order to profit from that. Now what's the move next on gold? You missed the big wave, right? So there's no resistance now. We're at highs that haven't been seen for forever. So we're saying, how do you get back in? Well, we know the support level then is the broken resistance. Sala, yeah, we'll get to some ideas, and I'm about to get to an idea on gold. What do you think this old resistance level that now got broke, here was the breakthrough, what does old resistance act as if the movement comes back down? What do we call the old resistance if the price comes back to here? That old resistance level becomes what? Typically, old resistance that's been broken becomes support. And so what kind of pending order could you put down here in case gold tests this support level? What kind of pending order would buy if the price comes back down to this 1 month candle support level now? The type of pending order that buys from a lower point is buy limit, not buy stop, buy limit, okay? So a buy limit pending order, if we brought up gold, we go to pending order instead of market execution, and then we say there are 4 types of pending orders. The type that buys from a lower price, buy limit. So I might say if the price comes back down to 1917, so the at price, 1917, then I want to buy. And my stop loss would be if it broke back below this old 1 month candle resistance. If it broke back below it, maybe to 1913, then maybe I'm out. Then I'd say, okay, that's a true reversal if it breaks that old resistance, which should be support now. And my take profit, I could leave that open. There's no resistance up here. There's one, if it bounces off this support, the first resistance would be the high point from today. So I could say if it gets near 1940, I'll take profit. Okay, and place. Okay, good. So now I have a pending order based on today's technical movement. We know this price level down here at 1914 is significant because it was a 10-year resistance level that got broke. According to support and resistance theory, a broken resistance should become support. Whatever fear caused that price level to get broken today, that fear should keep it from dropping back below it now, okay? No guarantee, but that's the theory. So now we say, okay, if the price comes back down to not just above this broken resistance, should act as support, I'll buy. And I'll take my profit at today's high point or near it, although it's climbing more now, isn't it? So that's one idea if you're waiting for a better price to buy from. If you wanted to buy, but you say, I don't like the price. The other idea would be, I'm going to buy now. Okay, I could also buy now. Maybe I do a smaller trade from the higher entry point and I buy on gold now. Okay, and I say, I think it'll keep climbing. But maybe I'll find a smaller support level to give up, like this one here. On my market buy, in case it keeps climbing, and if I believe it will, then I'll say, okay, here's the closest support level on the smaller candles, 30 minute. So my stop loss on my market move, maybe I'll put here, 1928. So I might say modify or delete, stop loss 1928 on my market move. Okay, so now I'm in. If it climbs, I'm in. If it comes back down, I get in at from a better price with a larger trade. Okay, kind of a 1-2 move. And I'm not risking much on the smaller trade because my stop loss is just a small distance below the first little support level. If it breaks that, then I get in at the next support level, which is a more major one, with a larger trade. Again, risking a small amount to my stop loss. Okay, just an idea. You don't have to do these exact entry points. You don't even have to do the direction I'm doing, right? You might say, well, if it breaks this support level, I'll sell. The same spot as I have a stop loss on my pending buy limit, I could also say, I'll put a sell stop. If it breaks that support, I'll sell. So in this case, you don't have to be saying, I only think it'll go up. You could prepare with a sell stop below your buy limit. So if it comes down, hits your buy limit, and breaks the support and hits your stop loss, then maybe you sell. Because then you say, wow, fear must have really come down if it broke back below that major support level that it broke above today. So, and you might say, well, why am I taking so many tries? And the idea here is I'm limiting risk and having a much larger potential profit. So in effect, I could be wrong on 2 out of 3 of these and still profit. And so, and I can just show you an example from the last couple webinars. I refreshed my history so it only shows what we looked at the last couple webinars. And you see the profit is over 4,000, right? And there's no guarantee that that's the profit you make because you're not necessarily doing the exact same trades that I'm simulating. But the idea is, if you look at the win percentage, it's not necessarily better than 50%. There's a winner, there's a loss. There's a winner, there's a loss. And look, the loss is bigger than the win in many cases. There's another loss. There's another, or there's a small win. There's a small win. We cut some of them out early. Look at that one. A much bigger profit than the losses. So we're setting up where, okay, we're risking a certain amount, and maybe we're even losing more trades than we're winning. There's a loss, there's a loss, okay? There's a loss, there's a loss, there's a loss. But when we win, the potential profit can be much greater, okay? And the idea is we're entering at strategic locations with major price levels where we see breakthroughs and reversal potential. This is what technical analysis is about. Getting opportunistic entry points to potentially win more than you lose, even if you're not right more than you're wrong, okay? At least that's one way to do it. There are other ideas as well, and we've had times where we've looked at having larger exposure and smaller potential profit, because then it's more likely to hit your potential profit. Typically, your win percentage goes up when you have a shorter distance to your take profit and a larger distance to your stop loss. Usually your win percentage goes up, but then when you lose more. So there's more than one way to do this, right? What I'm showing you right now is similar to what we looked at last week, where we're limiting the loss and going after a larger potential profit based on the technical strategic price levels that we see, where we think, wow, the market's on our side if we go this direction, based on the fundamentals along with it and the breakthrough levels that we see. Okay? Type okay if you're with me here, or if you have any questions, now would be a good time. Okay, so let's look at maybe some indices because I think they're interesting right now, and some stocks. So we could first look at maybe Tesla. Okay, we see Tesla pulled down some in recent movements. And so this goes to the 24th, which was Friday, right? Now, why is Tesla not moving yet? Because it's a US stock and the US market didn't open yet. Okay. And so if the US market did not open yet, The indices are moving because our indices are traded on the futures. So European, US, Asian indices, they're all moving. But the individual stocks are traded on the regular market price when the market's open for wherever the stock is from. So Tesla being a US stock, US markets are not open yet. It hasn't started moving yet. Okay, so Brian, good question. How do you decide what is a strategic price level? Let's quickly go back to gold for that question, since we already analyzed gold, and it'll make sense. So here's gold. Why is the price level that we drew, that we're seeing here, this price level here, why is that significant? If it came back down, you'd buy from that maybe. Or if it broke that level, you would sell. Why was 1915 or so an important price level strategically? Well, remember we looked at the 1 month candles, and look at that price level. 1915, that was the resistance level that hasn't been broken for about 10 years, even further back, right? Because the charts don't go to a higher price level than that. That is the ultimate resistance level. It got that high back in 2011 and hasn't broken it since or even tested it. So it makes sense that once it breaks that price level, it must have taken some significant news, some significant information on the market to make that price level get broken, because it has never broken it on the chart. So now that it broke that price level, when we zoom in, we see the line that I drew was right here. That was that price level. That way back in 2010 or 11, it tried to break and couldn't. Now it broke it. And look at how rapidly it climbed after it broke it. That's what we call a breakthrough movement. Okay? And buy stop orders above that level would have paid off nicely. Now, if it gave you a second chance at that price, you could have a pending buy limit waiting to buy off that, what should be a support level now. Because whatever caused it to break through, that news still exists and should cause it to stay above it now. That's the theory, okay? And so a buy limit buying off of here, but if it broke below it again, then it must have been significant news to cause it to break back below that price level. And so then you have a sell stop pending order that you could have ready to go as well. Okay, that's strategic technical analysis entry points. That's what we're talking about when we say that. Are you with me, Brian? It's not a coincidence that once it broke this price level, you had a $40 rise in like an hour, in a very short period of time. It went up $40 per ounce. That doesn't happen by accident. That happens because that was a strategic price level that once it broke, it shot up like a rocket. It was expected that that could happen at that price level, and then it did. Okay, so you could have set that trip line in the market, that buy stop order above 1914. You could have set that weeks ago, saying if it breaks that all-time high on the chart, boy, it must have been bad news causing gold to go up that high, right? And boom, it happened. And when it broke, it went $40 an ounce above it within a couple hours. Okay, that's called strategic trading or strategic entry points. Okay, so let's take a look then at Tesla real quick. All right, so we're looking at Tesla, and we see that it gapped down on Friday, and it has a bit of a support level here. When the US market opens, any of the US stocks, they're probably going to gap. Okay, what direction do you think the stocks might gap? It's hard to say. That's not an easy question because fear is up, right? So stocks could gap down, like here, like they did from Thursday to Friday. The price gapped down. But the futures are green. So the futures are climbing. A lot of times stocks open up when the futures are climbing. Here's what I would say. Overall, fear is high on the market, and usually stocks drop. So what would be an advantageous entry point if you think stocks should drop through the week this week? If Tesla opens up here, near the bottom of this gap, if Tesla rises to this location, what kind of pending order would sell from up here? And you can't place a pending order till the market opens. Once the market opens, if it starts working its way up, you could put a sell limit to sell from this location up here, thinking that it's not going to retrace this gap with the fear that's on the market, right? Or if it opens up here, you could do a market sell. If you think the fear on the market is going to eventually drive the stocks back down. And a natural stop loss then would be the top of this gap from Friday. Okay, or from Thursday, I should say. This was Thursday's close. This was Friday's open. And over here's Friday's close. So if you enter somewhere in this range as a sell on Tesla, your stop loss above the gap right up here might make sense, technically speaking. Okay, and I'm not here to tell you should short US stocks, but if you're looking at the fundamentals and seeing the fear is rising, and this FOMC meeting's coming up, creating fear, the US-China tensions are creating fear, then if you could catch an opportunistic jump with a stock like Tesla, and you have this gap as a stop loss buffer to put your stop loss above the gap in price here, strategically speaking, it could be a move that might make sense. Okay, and we can look at some of the other stocks. Citigroup, we see the same thing. By the way, you also could put a pending sell stop below the support. If it breaks this support, you could be looking at a further plunge of some of these stocks. So you see a nice support level on Citigroup. If it breaks it, that's sign of a downtrend, and you could think about shorting it. Everything you trade on, Peter, on our platform is a CFD. Stands for contract for difference. You're entering at a price and you're wanting to get out at a different price. So you're not actually owning the stock, you're just doing a contract for difference in price. Hopefully that goes the way that you're anticipating. So you profit. Barclays, same way, sets up that we can see downward pressure at the end of last week. And we can see, if we go to 4-hour candles, a support level right here, okay? It's almost on the support. So again, once the US market opens, if you think prices could drop, a pending sell limit below the support level could make sense. Let's say the market opens up, then, I'm sorry, sell stop, not sell limit, sell stop. A pending sell stop, if it breaks this support, could make sense. You can't prepare the sell stop till the market opens, but you could put a sell stop down here if you think a broken support is a sign of further dropping, okay? Also, what if the market opens up? Because the futures are green. If the market opens up, this is your first resistance level. And then if you think the fear will take over, pulling them back down, you're looking at an entry from up here. That would be an opportunistic entry at the first resistance level to be able to try and short some of these stocks like Barclays and have your stop loss up here. Okay? And this is actually, this is moving for us because it's Barclays. Okay? This one is live. Okay? So Barclays you could look at now because it's not a US stock. It's open with the European UK market. This you could put a sell stop if it breaks the support. That's confirmation of a downtrend. You could have a sell stop down here. You also could prepare a pending order as a sell limit up here just below this resistance level. So either way, you're in then. If it goes up, you get in on a sell from the resistance. If it just flat out breaks the support, you get in on a sell stop because it broke the support. Okay, now this is an idea if you think the greater fear that we saw in the fundamental news, if you think that'll take over and force these stocks or indices down. Okay, It's not something that I'm saying for sure these will drop. What I'm saying is if you feel the fundamental news is saying, hey, these could likely have a strong downward movement, then you could prepare with limited risk, a sell stop here to trigger if it breaks the support, to trigger a sell with your stop loss just back above. Okay, how would I do that? Very simple. Pending order, sell stop, sells from a lower point. I could say if it hits 107.5, I want to sell, just as an example. And my stop loss could be back up here at 112.5. And maybe I say 108.5. I would prefer to enter, something like that. So now I place my pending order. There it is. So my entry price is down here. Only entering if it breaks the support. It'll open a sell trade for me. My stop loss is back above that, what would have been that broken support. And my take profit, you choose a price level down here somewhere to take your profit. Okay, and maybe you look at 1-day candles and say my take profit would be the next support level somewhere down here. So you have a larger potential profit compared to your small, relatively speaking, risk. Okay, so that's just an example of how you could set up for Barclays now because the market's actually moving. And then the sell limit would be here. You could set up a sell limit in case it goes up first, if you're looking to short it. Okay, again, you don't have to short it. You could buy now off the support level. Why am I not simulating a buy position off the support level? Because the fundamental news seems to be that it's against the upward movement right now. So I'm tailoring the technical strategy to go along with what the fundamental news is maybe showing a preference should be. If you feel that this could bounce off the support, then by all means, buy on it. You absolutely can buy. I'm not telling you not to. And as a matter of fact, it would be a limited risk. It would be a limited risk. There's no reason why you couldn't say, okay, I'm going to buy off the support. And my stop loss is the same spot I would enter on my sell. Small risk, larger potential profit. So on the buy, you could put your stop loss just below that support to get out if it breaks the support, and then your sell stop triggers as a sell. And at the same time, your take profit could be at the same spot where your sell limit would kick in. Brian, you could put a trailing stop. That's one option. If let's say this buy position goes up a ways and you still think, wow, it might come back down, and before it reaches this resistance level, maybe where your take profit is. So you could either do a partial close. I'll show you how to do a partial close, or you could add a trailing stop. We'll do both. So let's say let's pretend this Barclays move is in profit, and I say, okay, I want to close part of it. So I go here, I do modify or delete. I go to market execution, and you see I have the option to close it. Okay, let me show you again. Right click over the trade, modify or delete, go to market execution, and now I can say, okay, I want to close 0.05 of the trade. So now I'm closing. It tells me the order number that I'm about to close, and it tells me the trade size, 0.05. So pretending I was in profit, right? It's not yet, but pretending I was, I just closed a third of the trade size. I took a third of the profit. Now the rest I can let run. Or maybe the rest I want to put a trailing stop. Let's say, okay, I want to preserve most of my profit. So I go here, trailing stop. Maybe I say, okay, if it goes back 100 points, I want it to close. So now I just added a trailing stop. I right click, trailing stop. You see the check mark there, 100 points. That tells me it's active, okay? 100-point trailing stop. So now if it goes back 100 points at any time, it'll close, preserving the rest of the profit that is showing. Right now, there's no profit showing because I'm just simulating the idea, but that's, Brian, how you could preserve profit, either partial close or add a trailing stop. one caveat with the trailing stop, it's only client side. It's not on our server, the trailing stop. So if you log out of your computer, if you lose internet, the trailing stop disappears. So keep that in mind, okay? Very good questions. Okay, so in this setup, I'm in for a potential profit if it climbs, because I took a market buy. And if it reverses and breaks, it hits my stop loss on the market buy and I get in on a sell. So that's a 1-2 strategy where you say, okay, it's a nice support level. I'll buy off that, take a limited risk. But then you say, I know the fundamentals are against me. So if it breaks the support, which I expect it could, I'm in on the sell stop. And I could get an even much bigger profit than what I lose on my buy off of the support. That's one way to handle it, right? I don't like the buy in this case because it's against the fundamental news. I would rather just get in if it breaks the support level or have another pending order up here if it climbs to sell from, because I'm leaning towards sell with the fundamental news. Again, that's my opinion, right? Based on the fundamental news. Technically speaking, you could go either direction here because the entry points are nice. It's a nice support level here that you could buy from, technically speaking. And some traders are just technical. They'll just say it's a nice support level, I'm buying. I tend to try and combine the technicals with the fundamentals as well. And that's up to each individual trader, which direction you go with that, okay? But the point is with the webinars is to understand the options, to understand how to do it and why you might do it. And then how you apply the strategy is up to you. Okay, so I see individual stocks with the potential to break support levels today. I think it could happen because fear is up. And when that happens, many times stock market moves the opposite direction of fear. Okay, not always, but many times. And whether we're looking at Citigroup, there's a nice support level that could confirm if there's a breakthrough, or looking at Netflix, also sitting at a support level. Netflix is interesting because Netflix has done well when other stocks haven't during the pandemic. So Netflix, if anything, I might trust the support level a little bit with Netflix. Maybe this is a nice support level to come up off of with Netflix, because worst pandemic has been good for Netflix, because what do people do when they're at home? When they're quarantined and can't go to work, they rent movies through Netflix many times. So this was an old resistance level on Netflix that broke through and became support, support, support. So when the US market opens, if Netflix is bouncing around above this support level, that could be a nice strategic spot to go long on Netflix with a stop loss just below the support. Very limited risk with the ability for Netflix to climb maybe potentially towards this high that it already established just last week. Okay, so very interesting setup with Netflix as well. And we can look at one more. Let's look at an indice maybe before we end things. NASDAQ climbing today, right? But reaching a potential resistance level right here. Okay, you see this was an old support. This price level here is a bit of a support level here, and now it's reaching that level. Okay, and if we go to like 5-minute candles, you see it's still uptrending. It has not reversed yet. But look at this level right here. Let me just adjust this a little. You see, this was the old resistance. Okay, resistance, 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 and then it came down. And now look where it's hesitating. Look exactly where this 5-minute candle hesitated, or 15-minute candle, I'm sorry. It hit and dropped. Where did this hesitate at? The exact resistance level here from last week. Okay, so it doesn't take much to say, okay, I'll take a market sell here, for example, right? And then I'll put my stop loss just above the 5-minute candle resistance, maybe at 10,669, okay, as an example. So I go back, I put my stop loss, 10,000. 669. Okay, so, and there's my stop loss, and I can move it a little bit by dragging it. It's above this resistance, right? If it breaks this resistance, I'm out. And I put it above the resistance by a little bit, okay? My take profit could be right down here, the low that it hit just recently. So my take profit could be 10,325 or 330, let's say. So let me modify again, 10,000, just as a simulation, 10,330. Okay, my potential profit then to the first support level down here is about 3 to 4 times potential profit compared to my risk if it breaks through and hits my stop loss. And that's a nice strategic location, right? Look at the resistance level here. Look at it. Resistance level, it's right on it. It's confirming that it respects that resistance right now. It's hesitating. So it's a limited risk to my stop loss above that resistance. And my potential profit, if it retraces down to where it was not that long ago, wow, what a setup. And why is the fundamental news in our favor here? Because the fear index is up. When fear is up, what tends to happen to stocks and indices? They tend to run out of steam and drop, right? Not always, but many times. So we're using strategic locations with our support and resistance levels, looking at the historic data, combining that with fundamental news to pick a direction that we think is more likely than not to occur. And all the while limiting risk in a way that makes sense to you while taking a nice shot at potential profits. All right, great. Any last questions before we end things today? I think the indices are offering nice locations because they've been moving the opposite direction that the fear index suggests they should. So you might have some opportunistic entry points for the indices and right now and any stocks that are open like Barclays. And you also might see some really big movements when the US market opens that you could take advantage of because the fear is up today and so are the indices, which is interesting to see what's going to happen. Could be some really large breakthroughs and movements. All right, everybody, thank you for joining. I appreciate you showing up at this unique start time. I think these movements could pay off quite well. Just limit your risk on the downside in case they don't go the right way, okay? All right, everybody, thanks for joining. The next webinar this week will be Thursday instead of Friday. All right, everybody, bye for now.